So we'd like to thank Secretary Lew again for being with us today. I think it's very, very important on this momentous period of time with Brexit, and for his leadership globally, which is going to be more important than ever over the coming months. Next, we are very fortunate to have a conversation on multilateral leadership and the global economy. And I'd ask you all to take your seats, because we have the first managing director of the IMF, an old friend, David Lipton, who's our host here today, who's seen many battles over the years on the international scene, and managing director and chief operating officer, Sri Mulyani Indrawati, who, as you know, in addition to her position here as chief operating officer and managing director of the World Bank, had a distinguished career in government for many years in Indonesia. The moderator of this panel is Faryar Shirzad, who is a global head of government affairs at Goldman Sachs, and we appreciate him taking on this task. And it'll be very interesting to hear the interchange with our host and Sri Mulyani, and we look forward to good questions from the audience. Thank you.
Thanks, Bill. Thanks, everyone, for being here. It's my pleasure to moderate our next session, which, as Bill said, will feature David Lipton, the first Deputy Managing Director of the IMF, and Sri Mulyani Indrawati, the Managing Director and COO of the World Bank. The session will focus on the state of the global economy, including a discussion of key risk factors, Brexit, as well as potential mechanisms for policy response. We'll also discuss, obviously, the critical role of the Bretton Woods institutions in managing and responding to these risks. We had a very interesting discussion with Secretary Lew just now, so it'll frame many of these issues well for our discussion now. As for format, I'll invite each of our speakers to come up and give a few prepared remarks, and then we'll have a question and answer session that I'll lead initially, and then we'll allow the audience to ask questions as well. What I'm going to do is I'm going to ask David to come up and start us off. As Bill said, David is somebody who has extensive experience in international economics and international finance, including having served as Senior Director for International Economic Affairs for President Obama, and in the Clinton administration as Undersecretary of Treasury for International Affairs. So let me turn it over to David, and then we'll go to Sri Mulyani.
Thank you, Faryar. Welcome to all of you. Welcome to the IMF. Let me start by thanking all of you from the Bretton Woods Committee for your strong support of the IMF. You played an important role in backing the 2010 quota and governance reforms, and passage of those reforms really positioned the fund well to respond to today's challenges and to be better representative of our membership in the 21st century. Well, there were an awful lot of dramatic headlines over the weekend suggesting that Brexit signals the beginning of the end of globalization. Surely it's too soon to feel comfortable that we understand all the ramifications of the British referendum. But at the same time, I think it's surely a good day to make the case for multilateralism, and that's what I want to do today. While there are plenty of reasons to be concerned about the future, I'm going to argue that globalization still has important promise. But to achieve that promise, we're going to need to take a fresh look at multilateralism and the role that the IFIs can play. I think it's more clear than ever that we're going to need the continued support of the Bretton Woods Committee. So this meeting today is fitting. My generation can be excused for assuming that history moves in one direction. We've experienced globalization, and with it, rising incomes, economic progress at home and abroad. Our experience, of course, was very different than our parents' generation, which came of age experiencing depression and war and economic disruption. But now the Brexit vote raises the possibility of an abrupt change in direction. While that vote itself may have hinged on sentiment about migration and about sovereignty, its effect will be the withdrawal of the UK from one of the greatest projects of economic integration. European unity has been a part of our generation's narrative, from the creation of the coal and steel community to the creation of the euro to the reintegration of Central and Eastern Europe. Brexit at least is an interruption of an important integration process. So could the same doubts that gave rise to Brexit lead to an interruption in globalization? Well, many people say globalization's unstoppable. Integration's been achieved. There's no going back. I hope so. But Brexit and the economic trends in the world and the political reactions, I think, should cause us to pause and to think again about the question of irreversibility. Despite decades of deepening integration, many have come to question whether closer global integration actually brings them meaningful benefits. And they see costs and vulnerabilities, both economic, but especially social and cultural. Without clear economic benefits, the costs, including a lack of a sense of control, can dominate public opinion. The critics can point to some evidence, in particular, for people in advanced economies, the global financial crisis was a hit to wealth, and for many to their retirement prospects. And of course, growth is still sluggish, so future income growth prospects are questioned. People feel the effects of income inequality, stagnating wages, and a lack of job security. And they see and fear market volatility. At one level, we have to admit that there are some economic forces at play that we don't really fully understand. We can't satisfactorily answer some very important questions. Are we in secular stagnation? Does the trend toward lower real interest rates over the last 15 years reflect a drying up of investment possibilities? We'll need to continue looking at these questions. But what can we say? Let me make 3 points. First, globalization has lifted hundreds of millions of people out of poverty and raised living standards across the globe. I believe there's still every reason to believe that globalization holds the promise of supporting rising living standards in advanced economies as well as emerging and developing countries. But to preserve and protect that promise, we'll have to work to enhance the gains of globalization, limit the costs and vulnerabilities, and then make the case to a skeptical public that globalization has value. Second, as has always been the case, much of what needs to be done requires action at the individual country level. And at our April meetings, we at the Fund have called for what we call a three-pronged approach to boosting growth, with support for demand coming from both fiscal and monetary policies so that there's not undue reliance on monetary policy, and with structural reforms tailored to support demand in the short run and to boost potential growth over time. While this remains the right recipe, it's clear that individual governments see limits to their room for maneuver, and so far have not made enough progress. And third, we need multilateralism now more than ever. Part of the political problem today is that national leaders cannot really solve domestic problems, nor fulfill the aspirations of their people with just domestic action. That's because their country's prospects depend too heavily on global prospects. That's something that will be true in the United Kingdom, in or out of the European Union. So we need everyone pushing in the same direction at the same time. That's why it's important for the IMF to rally its membership to act in harmony. With each country doing its part, the impact will be greater. And leaders can then have some greater assurance that growth will be based on demand creation, not demand diversion. And we need to make sure that the international monetary system is supportive of all of those individual country efforts, creating growth opportunities and lowering vulnerabilities, not creating vulnerabilities. When I say that, I have a few things in mind. Even if the advanced economies are facing a form of secular stagnation, and they may, in principle, the emerging market and developing countries hold the potential to be the engine of growth for the next generation. If they can achieve rapid growth, which leads to a convergence in their living standards towards advanced economy levels. However, right now we're seeing a perverse development, a slowdown in potential growth in emerging market and developing countries. With present IMF projections, many large emerging market countries cannot expect to see convergence at all. Why is that perverse? It's perverse because with the availability of technology, internet communications that create educational opportunities, ample funding for investment, new financial engineering that can spread risk, countries should be accelerating and speeding convergence in living standards, not slowing. Now, surely emerging market and developing countries have much to do at home to adjust to global events, to deal with the legacy of crisis, and to foster faster growth, better climates for investment and growth. But the volatility of the global economy, and especially of large flows of short-term capital, has just not been helping. Rather, it's leading emerging market and developing countries to have to act defensively, guarding against openness, worrying about borrowing and current account deficits, sudden stops in capital flows that can cause contraction, and self-insuring with weak currencies and reserve accumulation. Re-examination of the international monetary system can help here. We can re-examine how macroprudential and capital flow measures could provide protection and the do's and don'ts of using such techniques. We can ask how to promote growth-supporting equity flows and how to discourage volatile short-term flows. And we can better promote technology transfer. And then, of course, we can create a better global financial safety net, including through IMF coordination with regional financing arrangements, and possibly new IMF lending facilities as well. There's also room for cooperation with new multilateral institutions like the Asian Infrastructure Investment Bank, whose formation we welcome. Let me end by observing that the new normal in global economics has a parallel, an important parallel, in global politics. Ian Bremmer of the Eurasia Group has dubbed this the G0 world, a world characterized by a vacuum of global governance. Hegemony, for better or worse, no longer prevails, nor are traditional security relationships coping with the evolution of global security challenges. With a growing number of important geopolitical risks, and as we see, adverse impacts on economic growth and stability, we'll need to pay more attention to the interplay between economics and geopolitics. We see this already in the work we're doing, addressing events in the Middle East and Africa, addressing the refugee issues in Europe. In the economic realm, the IMF can be a voice for global cooperation and for collective action. I believe the IMF is stronger than ever and that we're better able to deal with economic challenges than we've been. This is in no small part thanks to the work of the Bretton Woods Committee, so thank you again for your support. Now we must continue to address the new challenges that arise, address them with creative multilateral solutions, and respond to the changes we see in the global economy. Thank you very much.
Thanks, David. Very interesting. Now let me introduce Shri Mulyani Indrawati, the Managing Director and COO of the World Bank. Her responsibilities cover all aspects of the bank's operations. She also has a very long and distinguished record in international economics and international finance, including as Indonesia's finance minister. So we'll hear from her, and then we'll do our Q&A.
Thank you, Faryar. It's really a pleasure to be here again today, and I think as a third speaker, I agree mostly with all David as well as Secretary Liu have raised since this morning. Obviously, the recent developments are presenting additional challenges for the global economy by injecting more uncertainty into an already weak global economic environment. Now everything needs to be rethought, and the specific effect of the new reality are still to be determined. On the other hand, the world has set itself ambitious goals, including the World Bank's goals of ending extreme poverty by 2030 and promoting shared prosperity. We also know that the world also have a new set of targets, the Sustainable Development Goals and the Paris Agreement to limit climate change. These are important global commitments, but their implementation is facing serious challenges. We see two types of risk, cyclical and secular. Among the cyclical risks are the overall weak global environment, the slowdown in emerging markets and economy, and the end of commodity supercycle. Even before Brexit, we at the World Bank are concerned about the fragile global economic situation and increased volatility. In June, we revised our global forecast to 2.4%, down from 2.9% we projected in January. Apart from the United States, we saw no real bright spot in the global economy. Europe was still struggling to recover and now also struggling with the Brexit. And Japan isn't kickstarting its economy as expected. Developing and emerging economies that were engines of growth during last decade continue to underperform. Brazil and Russia are in recession, and China is rebalancing its economy to lower levels of growth. This in itself has injected some uncertainty, as already discussed in the first session. Related to this development are weak global trade and very low commodity prices. Commodity exporting emerging market and developing economies, many of them home to millions of poor peoples, have been hit very hard. They alone account for 40% of the downward revision in the global economy. Growth of this economy is projected to advance at a meager 0.4% this year. This is a downward revision of 1.2% from the January outlook. Furthermore, we are also concerned with the increased debt exposure and overall limited monetary and fiscal policy space. So obviously, the tools, as Secretary Liu mentioned earlier, is becoming very limited. But we cannot attribute the global downturn solely to cyclical factors. On the secular risk side, we see strong driver undermining growth potential. One of them are demographic trends. As the working age population and productivity decelerate, growth will be harder to sustain, and the goals of the World Bank, ending poverty and promoting shared prosperity, will be much harder to achieve. It will become even more urgent to create jobs, enhance basic human development outcomes like education and health, empowering women, and lengthen productive lives and reduce inequality. Automation will increasingly compete for jobs in agriculture, manufacturing, and also in some services. This will complicate the economic transformation further of many low-income countries. Demographic trends will demand sustainable health and welfare system for aging population and creating 500 million new jobs in developing countries where populations are growing rapidly, as in Africa and South Asia. And then there are also secular risks, such as climate change. According to our study, unabated warming will create additional 100 million new poor people. And of course, also a tense geopolitical situation and widespreading conflict create additional volatility. There are now 65 million people forcibly displaced within their own countries or also live as a refugee abroad. And I think this is one of the factors that trigger the Brexit. In sum, we have a tough mix of risk. At the minimum, these risks present a complex set of challenges. In worst-case scenario, they could result in a setback in which the poor and vulnerable will be affected most. So the question is, what do our client of the World Bank Group do to address to these challenges, and what we could do to support them? With many of the countries face monetary policy measure which is becoming exhausted, and fiscal policy constraint in many countries face very severe, structural reform are seen as a solution to rekindle the growth. They are now on the minds of many governments around the world. And we see a sharp increase in demand from our services. Many of our discussion with countries recently is really based on what is the need of the structural reform, not about what needs to be done, but how to do it. This is not just about lending money, but the country want to make a more resilient and building a strong foundation for growth. These include a wide range of legal, regulatory, institutional, even logistical changes that directly or indirectly make investing more attractive. As you may all aware, the bank has long-standing experience in supporting countries who are implementing this reform. With our presence in many countries and toolkits that we are having from policy lending, investment lending, program for result, guarantee, knowledge, as well as working with the private sector. Empirical evidence suggests that structural reform can move growth path to a higher trajectory. We are responding to growing client demand by supporting reform to spur growth and specific action to bolster safety net and protect the poor, especially during this volatile time. For example, the bank policy support and advice include cutting low productivity expenditure, for example, like subsidy, while at the same time protecting the poor from the reduced growth from their policy adjustment. This include public expenditure review in Angola, Argentina, Brazil, Chile, and Peru, and also helping to target energy subsidy to the poor in Ukraine and Nigeria, and looking at the efficiency of social program in Russia. Improving the effectiveness of tax system. This is in Indonesia, China, and Egypt, and also improving debt management like subnational debt restructuring in China. We also engage in fostering diversification of the economy, for example, by relaxing investment rules in Indonesia and Argentina and expanding value added from resources, for example, like cashew and cacao in Cote d'Ivoire, and improving trade logistics, for example, in Burkina Faso, China, Sri Lanka, Indonesia, Cote d'Ivoire, and Morocco. We also engage in labor reform in Turkey, Poland, and Serbia. The bank is also monitoring financial sector regulation and working on the de-risking investment to developing countries. But we also cover areas like improving governance, increasing domestic resource mobilization through better tax system, and general capacity building. The way we can share expertise and experience currently is not just north to south, but many of the country is interesting to learn from south to south or even from south to north. Convening the right people in the right place, whether expert, policymakers, or government, still makes us the go-to partner for complex development approaches. Let me close by saying that we are very closely aligned with the goals of our shareholders, whether they are donors, borrowers, or both. At the heart of our works, our common goals of ending extreme poverty and promoting shared prosperity. But in this fast-changing environment, with both cyclical as well as secular challenges, we need to continue to evolve as well. whether it is by developing new lending instruments like offering catastrophic risk insurance to the worst country or launching the pandemic risk facility. The demand for World Bank to do more on the global public goods is becoming more and more important. We also optimizing our balance sheets through efficiency gains and leveraging donor contribution in new ways for IDA, our fund for the poorest, and by innovating our approach to address development challenges in highly fragile and conflict-affected areas by creating a special economic zone in Jordan and Lebanon, who are major transition country for refugees. So in everything what we do, we partner. This is truly what we call it a multilateralism in action. We cannot do it alone. Our relationship with other MDBs, the IMF, the UN, and civil society groups, NGO, and very importantly, the private sectors, are critical to deliver toward an ambitious goals that is the world without poverty and improving shared prosperity. I know that global cooperation and compromising for larger goals has currently lost its popularity, as mentioned earlier by David Lipton. But I can tell you that we still do it in the World Bank every day and working together with many partners in order to always continue making a case for better multilateralism and globalization. Thank you very much.
Thanks to both of you. David, Shri Mulyani, just as a part of her prepared remarks, did an interesting overview of sort of essentially a tour of the horizon of what she's seeing in terms of the economic trajectory globally. Can you share the IMF's view or your view on that?
Yeah, let me say I think there are three important processes going on that will determine what happens region by region. The first has to do with the recovery in the advanced economies. How successful will Europe, Japan, and the United States be at restoring growth, in particular in supporting domestic demand so that their growth is demand creating rather than mainly demand diverting. And if this happens at different speeds and exchange rates move and there is some demand diversion, what will happen if there's asymmetry in the normalization of monetary policy? I think this is something we've seen a bit of in the last few years. I think it's an unfinished process. But how it plays out, the choices that are made in terms of the policy levers, the forcefulness of the policies, the success is going to really affect the countries all around the globe. Second is the process of adjustment to low oil and commodity prices. Obviously, there have been winners and losers. I think we've been a bit surprised that the lower oil and commodity prices have not led to as much spending and growth in the countries that have been oil and commodity importers and who had a large terms of trade gain. And in some instances, that's because the gains have been saved or have been utilized to improve fiscal positions. I think there's a much more conspicuous adjustment underway in oil and commodity exporting countries, and one that will be with us for a while and is quite consequential. Countries that have suffered lower revenues are seeing their currencies adjust. With lower fiscal revenues, there's a need to make fiscal adjustments. I think most countries have to presume that the price declines are, for the most part, to be long-lived or permanent, and so they really do have to adjust. And this is something that's causing difficulties in a number of countries and will be a drag on growth. I think we're also seeing that the receding of the commodity supercycle is revealing that there's a substantial amount of excess capacity in a wide range of, in the oil sector and in a wide range of commodity sectors. And for that matter, probably in traded goods manufacturing as well. That's something that's not a cyclical issue, or it's a long cycle issue, and it may take really quite a few years for that to work off. There are countries that need to decide whether and how fast to reduce that excess capacity, whether there's a need to shut in capacity production capacity, and we certainly want to see countries avoid subsidizing or using the exchange rate as a way of perpetuating production capacity that really is unnecessary and is simply going to be contributing to continued sluggishness in traded goods price developments. But I think this is a kind of overhang that is going to be with us for a while. It's also important, going back to the advanced world, because I think it means that the advanced world has to count on this process continuing in the emerging market and developing world, and take that into account. There will be, in a sense, continued spillover that comes from that, and the need, certainly we see the need to be thinking globally about the appropriate level of global aggregate demand, and that has to take into account the working off of this capacity. The third process, of course, is the rebalancing in China. And whatever one thinks about projections of Chinese growth, it's clear that China is reforming, is rebalancing. When you go to G20 meetings and listen to the Chinese government explain what they're doing to reform, they are on the forefront of G20 countries in terms of reform, and they are major contributors through their reforms to contributing to global growth. I think we should not lose touch with the fact that even at today's growth rates, the Chinese economy this year, the growth of the Chinese economy will be the equivalent of adding a country the size of Sweden to the global economy. So this is still very substantial growth. At the same time, we have to, I think, conclude that China's not doing enough to rebalance, and that some of the policies that they're carrying out bring risks. If growth is being sustained by money and credit, if the credit is flowing to enterprises that may not use those resources well, have either diminished or no profit prospects, that may, in a sense, be value subtracting companies or industries, they need to adjust. Rebalancing in China has to have two parts: growing the new sectors, the sectors that are going to be supporting household income, consumption, and that means services, but it also means the many consumer durables that hundreds of millions of middle-class Chinese households are going to want. But it also has to mean downsizing or right-sizing the old economy, especially the state enterprises that are in the old economy. Now, if China does this in an ideal way, growing the new economy, right-sizing the old economy, that rebalancing, even if it's done really well, is a very consequential event for the global economy. Already, we see that the slowdown in growth in their, let's call it, older sectors, the industrial and export sectors, is affecting the supply chain in Asia. Countries that have been supplying into that chain have to adjust. It's affecting oil and commodity exporters who've been supplying raw materials. It's affecting sophisticated industry in Europe, in Germany, that's been providing high-priced and quite sophisticated capital equipment for industry. Already one sees that there are losers, but there will be winners too. There'll be the winners who figure out how to supply the Chinese household. And already I was in China and Japan the last couple of weeks, and there's a huge boom of what the Japanese are calling inbound consumption, meaning Chinese coming to buy things. And they're coming and buying fancy Japanese toilets and various other consumer goods because this is going to be a huge middle class that's going to want modern, durable goods. So we will see who the winners and losers are, but I think the point is rebalancing, even if China can avoid difficulties will be consequential. Now, rebalancing may not be successful. We have expressed and in our discussions in China in the last couple of weeks, we've discussed the need to deal with the debt and the lack of profitability in some industries, in particular in state-owned enterprise. We've argued that China has advanced liberalization to a very great extent, and now it needs to accompany that with improvements in governance in its enterprise sector, both public and private, but especially the state-owned sector. It needs to deal with the legacy of debts of the corporate sector, and as a result, what will be questionable loans of the banking sector. So if this is not handled well, then the rebalancing will be perhaps more bumpy, and the problems for the world, for China and for the world, more severe. In any case, I see those three processes or transitions as likely to shape a lot of the global terrain in the coming years.
I want to ask both of you about Brexit, but let me ask Shri Mulyani on China in particular, given that David sort of went through a number of the factors. The World Bank is watching these obviously quite closely because one of the biggest poverty alleviation challenges is the one that's inside China, but it's one that also has a political dimension to it in terms of the potential social and political sort of dislocation that would occur if this process of economic transition isn't handled in a way that's sustainable domestically. Can you tell me your level of confidence in terms of what China is doing and in terms of its ability to maintain and ultimately get back to sustain economic growth in a way that can become an engine for global growth?
Well, I think, as mentioned also by Secretary Liu in the morning, I think in many of the occasions that we see that the policymaker there knows that the adjustment is really needed. So this is not a question about what needs to be done, but more on how to do it, and especially in dealing with the political process, especially with this change of the growth models. I think from the World Bank point of view, we support all the necessary from both the knowledge side as well as the experience of other countries on how they are going to change their growth model. For example, in many of the study that we did, and this is really jointly with the Chinese authority, like the China 2030 or the urbanization, local government finance, and then the last one that we are going to launch is actually on a health care system in China. As you all know, I think if you are going to move from the investment export-led growth into more consumer-led growth, then you are going to deal with whether the household has all the safety net as well as confidence for them to be able to become the engine of growth. Then that's also linked to their ability to access the social safety net. And this is with their hukou system or their spending for the health system, which is not actually becoming better for the financial fiscal point of view, but also for the satisfaction of the household. So this is the kind of interaction that we are dealing with the government. With that kind of interaction and engagement, you have more confidence that they are not only asking about what needs to be done, how to do it, but also in this case is learning and willing to learn from so many other countries. I think this is just to show that there is a political process in order to create both a constructive pressure for the policy maker and policy process there in order to provide evidence base so that they are going to be able to then design the path of the adjustment. As David mentioned, my own experience in Indonesia, any adjustment is always difficult. I mean, when you are really talking about the excess supply in steel and coal, and you are going to reduce them, you are really dealing with the human being, the labor force that is going to be dislocated. So this is not just today that you are working in a cement industry and tomorrow you are working in a health industry. That's not like something that can be done immediately. There is always a process. And this both political and social process is the most important in order for the international community, or again, in this case, institutions like us, in order for us to really make a case that multilateralism is actually have a very important role in facilitating this kind of critical transition for important country like China.
So let me ask both of you about Brexit. David, maybe you first. I was interested to see that Managing Director Lagarde over the weekend and the IMF put out a statement essentially exuding some measure of confidence, and Secretary Liu as well, in terms of the market dislocations that we're seeing are really sort of a normal reaction. So I have a two-part question for you. One is, what risk factors are you watching for in terms of the response to Brexit that would take you off of that measure of confidence? And then the second is that I was interested in the IMF seemed to, or at least Madame Lagarde seemed to suggest that quick movement and some measure of transparency about next steps was important. You could actually argue that the opposite is true, right? That there needs to be a period of cooling off, reassessment potentially in terms of within the UK in terms of what they want to do. Can you sort of respond to that in terms of the Brexit?
Yeah, sure. First, I think, as Secretary Liu has said, the market reaction, while market moves were large, seems to have been orderly. Markets have been liquid. I think we owe a lot to the coordination that central banks made in advance of the Brexit vote, that central banks have learned a lot from past experience and understood that one needs first to make sure that banks and other financial institutions were positioned safely ahead of such a major event, that they had a lot of liquidity on hand. I think the Bank of England has worked on that for quite some time, and that there are both domestic currency liquidity lines available, and that everyone knows they'll be available, but also the fact that this time round arrangements were made ahead of time to have foreign currency liquidity lines available, so that there wouldn't have to be any reaction after the fact. This was all prepared and well known. I think this has helped create a situation where the market reaction has been orderly. Of course, these changes reflect to some extent the market's present assessment of how fundamentals have changed, and we'll have to see whether these judgments are borne out. But we understand, and we said in our own analysis, that fundamentals would be changed by this. If there's a subject to keep watching, I think it's whether, beyond assessments of fundamentals, whether these market moves themselves are going to have effects. I mean, after all, when stock markets go down, when equity prices go down, those have effects, whether it's wealth effects for the holders of equity, whether it's individual effects for institutions whose equity prices have moved. We'll also have to see who is positioned how on all of these market moves. There have to have been some winners and some losers. I think many banks were careful to, and the UK was very careful with its banks to try to make sure that there weren't exposures, say, to currency swings. But I think we'll have to see whether there's individuals, companies, institutions affected by the positioning and whether there are macro effects that come from the market moves themselves. As far as where we go from here, I think our concern, which we expressed for months in advance of this vote, was that it was clearly adding to uncertainty in markets. And we understood that a vote to leave would mean a protracted period of uncertainty. We know that that's not an uncertainty that will go away immediately. I think our point has been that, of course, the process from here involves political decisions, political judgments, discussions between UK authorities and European authorities. Our point is that those undertaking the political discussions should keep in mind that the uncertainty will continue to have an economic effect, an adverse effect, and take that into account, which is not to say that we have a timetable in mind, or that we fail to appreciate the point you made that preparations and actions will take time, even once, if and when the Article 50 is triggered. There's a mandated up to 2-year period for discussions and decisions on what would come next. So we understand that there will be a period of uncertainty, but our point is to suggest that the decision-making, political decision-making, take that into account and try to avoid unnecessary uncertainty.
I think the most important for the World Bank is, of course, to look at many of the clients. As David mentioned, this element of uncertainty, which is injected in an already very weak global growth, is going to really affect in the immediate and medium term for many of the developing countries. The first that you can see over the weekend is, of course, the exchange rate, and of course, flight to safety in this case, especially if you talk about the financial and capital flow. And that's definitely affecting many of the policymakers in developing countries with a weaker exchange rate and more of flight to quality of the capital flow, make the many developing countries have to revise down while dealing maybe the inflation because of the imported inflation coming from the exchange rate, weaker exchange rate. The weaker global growth is definitely will demand less of the export of many developing country exports, so it will even weakening what we call it the cyclical trend, as I mentioned earlier, that is more for the commodity-based countries, as well as there are those who's relying on the natural resources like the oil is, then you can see that they are also declining with this kind of sentiment. So all in all, I think this will create quite an environment which is much more challenging for many developing countries. The question for them is, of course, the tool or their policy room is becoming even much tighter. And this is going to give a real, very strong message for us during this summer, actually, and heading to our annual meeting. Is going to be more for many countries whose demand for a deeper and more ambitious reform for many developing countries to rely their own growth model on their own both domestic or in this case with new trading partner that will much more reliable. I think that is going to be the biggest message that we are going to watch. Certainly this is one of the areas that the World Bank will look very closely, especially for many of the client countries.
I know we need to leave time for audience questions, but I have to ask this question. I mean, I think part of the Brexit vote seems to be a reordering of the political calculus that the Bretton Woods institutions have to undertake when they think about the programs that they're administering, the WTO as well, in the sense that the calculus had always been the degree to which you can convince countries to undertake the necessary reforms. It now seems that the most successful, the most developed countries now have a restless middle class, working class populace that is not satisfied by economic success and is willing to basically throw the system out as a way to sort of express its unhappiness. Does that change sort of the calculus for both of your organizations? How are you guys going to manage this new world? Maybe Shri Mulyani, I'll start with you.
Well, always the conversation about reform in any country is not always easy. I mean, if you are talking about from the exchange rate policy up to the trade policy, or even much deeper, for example, like the labor policy and competition, I think it's not going to be easy for all those countries. And the question about this trade integration is becoming much more challenging. We at the World Bank is quite systematically promoting this trade integration or integration, regional integration, as one way that is going to accelerate growth. And we are seeing this in Southeast Asia, ASEAN 10 maybe is more or less. Look at the
talking
Asia.
about the donor countries, right? I mean,
Yeah.
that's the interesting thing is,
in the governance of
Yeah,
our
in the sense that the
institution
United
in this
States is
case.
having a bit of a populist sort of insurgency. The UK just had a populist insurgency. Parts of Europe are having, in fact, the countries that are most economically successful,
Yeah.
that are the models of the development models, are the ones that are having this insurgency.
I think the most challenging for our shareholder in this case, when the shareholder, which is representing by many of the Minister of Finance, they still continue expect institutions like us will reflect those kind of value of like openness, globalization is good, and so on. But they have to deal with their own domestic politics, which is again this kind of value. So I think it's not really on the bank, but maybe more on the shareholder own credibility in advocating or asking or pressing this kind of value through this institution to institutions like us. I think that is going to be the most challenging for institutions like the World Bank. I mean, in this case, if we are more reflecting the true multilateralism, which I think we are 189 shareholder, I think it will be much stronger for us to make a case that this is not only dominated by a few shareholder value. But that's can also quite a very important and challenging at the same time, because as you mentioned, and this is really the case, I mean, Bretton Woods institution, or in this case, World Bank, we are, of course, engaging with many of our client country using the tools of financing, but also on the policy reform. And when we are engaging with them, because we are using both the platform of based on the evidence, that is the research, the study that we are having, but also because we believe that openness and more interaction and engagement on the globalization is good for countries. But it's not always good for everybody, and that's why we are more and more focused on this globalization will create winner and loser, and how to make sure that this loser is not going to be just abandoned and for them to just struggle and suffering, but we are creating more, for example, like safety net, or creating much more affirmative policy in order to strengthen or compensate the loser, while at the same time to create more inclusive growth. I think that will create more, as Secretary Liu mentioned, you are not talking about the idea abstract, but more on how to translate this to the daily goods of the people, from the income point of view, as well as their ability to mobile upward to the social ladder. That is going to be really a challenge when major shareholder in this case is going to advocate more inward looking and protectionism, because then you are going to create a credibility gap in the way we are going to voicing. I can imagine, I was finance minister in Indonesia. In each developing country, you also have a political constituent which is very nationalistic, very inward looking. So when all these finance minister of client country engage with us, and the bank said that, well, you need to reform, changing your policy trade, becoming open, and then they will ask, well, you know, your shareholder is even now more inward looking. That, like it or not, is going to affect the credibility of our institution. So it is really worrying in terms of this kind of trend. And especially if it is not only 1-2 countries, but they see it in like a global scene, that now Europe is not also believe in this openness. UK choose to exit. The United States have your own election. And that's really, they look at it every day. I mean, they're really following this election every day. Like it or not, it will affect the way we are going to engage with many of client countries.
I think it is a challenge to us that many are losing their faith in the future. And I think that's what's giving rise to the discontent. But I think for those of us in the international community, the IMF, the World Bank, for those of you in the Bretton Woods Committee, it's important that we continue to make the case for globalization. People's attitudes will be shaped by their prospects. And we've, for example, been advocating the kinds of economic policies that we thought would lead to faster recovery from the global financial crisis, that would ward off risks and vulnerabilities. I think that there's more to be done in that, in those areas. That was the point of my remarks at the beginning of the session. It really matters whether we can help countries take the right steps and make progress and speed recovery and deal with the uncertainties and the volatilities. That will, in turn, in time, shape public opinion. Now, at the same time, I think we have to pay attention to subjects that haven't traditionally been in our main focus, but that are affecting macroeconomies these days. I think inequality, inclusiveness, some of the issues around the effects of climate change on the economy and on people. These are subjects that had been thought of as peripheral, but I think they really now clearly are affecting macro outcomes, and in turn, because of that, affecting people's views of the world. We're trying very hard to look at new ways to improve the macro outlook. Managing Director Lagarde has been a leader in the world in pointing to the benefits that come from gender equality and gender inclusion in the global economy. And at a time when we really do need to find ways to boost growth, boost well-being, this is a mighty important subject. Having just been in Japan, where the female labor force participation is rising and is now starting to approach that in some other countries, it's bringing a benefit. It's coming at a time when demographic change has been a quite debilitating factor. So if we can try to take on whatever subjects are really relevant or likely to be central, find ways for countries to improve their own lot, but also be much more open than we've been to thinking about how how well or badly the international monetary system is performing. We really need to try to find ways to maximize the benefits of globalization, minimize or lessen the costs and vulnerabilities, and then go out and make the case to people that this is worth carrying forward.
We only have a couple of minutes, so let's just do one question from the audience and a quick response. How about right there?
Thank you very much for great insights. Cenk Sidar, SG Advisors. Basically, my question is about the emerging markets. You mentioned the high indebtedness, the high current account deficit, and the risk of sudden stop of the flow, capital inflows to countries. So specifically, Poland and Turkey are two countries with very match the criteria you just mentioned, and they're geopolitically also facing significant challenges. What will be the IMF response to such a situation that both countries facing significant macroeconomic and financial shock, or what will be the solution, the multilateral approach to that? Thank you very much.
I mean, the two countries that you mentioned each have their own domestic challenges, and for some time we've given advice to look. I think Turkey is a country that has shown that it can. It has diversified in an important and interesting way. It does business with Western Europe, with Eastern Europe, with the Middle East, with North Africa. But it does have some vulnerabilities in the way it manages domestic policy, in the outcomes that it has in terms of current account vulnerabilities. And so acting in a way that limits those is important. I mean, I could give similar kinds of assessments for Poland or for other countries. But I think that at the same time, the risk of sudden stop comes in part from the volume and short-term nature and volatility of capital flows. Turkey is a country, and there are a few others, that has long been a recipient country for what's commonly called carry trade positions. I think we need to ask ourselves, what are the benefits of short-term capital flows? Are there really benefits? What's the reason that we observe such significant carry trade flows? What are the impacts when changes in risk sentiment can lead carry trade flows to stop or to reverse? I think asking this broader set of questions about how the international financial system works, why we have so much short-term capital flows and so little longer term and in a sense so little equity flows, whether they're aspects of the way we have organized supervision, tax laws, other policies around the world that are affecting those outcomes. And think about the multilateral setting in which countries like the ones that you mentioned are operating.
Shri, do you want to respond to that as well?
No, I think that's a question for them.
Okay. Randy tells me we have time for one more, so how about way in the back?
Yes, Len Bracken, Bloomberg BNA. The question for the panelists, but also for the moderator, would you comment on the prospects for the passage of Trans-Pacific Partnership generally and particularly in light of Brexit?
I don't have a political crystal ball and can't tell you about the politics of this. We've looked at TPP. We think that this is an agreement that could bring significant benefits to the participant countries. Having just been in Japan, I know that Japan is of the view that it would benefit substantially from TPP. The benefits come in two kinds. I mean, there are the trade-creating aspects of the various provisions, but they also are very alert to the domestic political disciplines that come from joining an agreement like this. I suspect that there are many other countries around that will feel the same way. I hope that the U.S. Finds a way to act on this soon, because I think it's a meaningful, really an important trade arrangement.
Well, from the trade partner, I think some of the exercise showing that there will be a positive benefit for example, like Vietnam and Malaysia is going to enjoy this benefit, and that motivates Indonesia to then want to join. I think that is really a positive trend. So in a way, there is really a positive case to be made, but the political environment, as I said, on a trade agreement, this is getting really tougher to make a case in each of the domestic policy, even when you are actually presenting the positive evidence. For example, like if you look at the growth on a trade volume and even a job creation is actually quite positive. But still, again, just like in any of the reform or change of the policy, there is a winner and loser. And the political process in order to ratify any of the agreement is really depend on how you deal with the loser, not actually really dealing with those who's going to benefit this institution. That's in the United States. That's also the same in many of the other developing countries.
I mean, for my part, having been involved in a number of trade agreements that we've tried to get through Congress, what I can say, and Ambassador Froman will speak to it more fully, is that it's rare to have a trade agreement where you whip the votes, in essence, count the number of senators or congressmen who are willing to support it, and come anywhere close to passage until the issue is actually put in front of Congress formally for an actual decision. The politics of trade agreements are hard. You don't really know where the numbers are until you force the issue. And so the question, I think, for this administration, if they hope to get it done this year, is if they can get the leadership of the House and Senate to put it on the agenda, whether it's this year or in the lame duck, so that the issue gets forced and then we get a real sense of where the alignment of support is. And a lot of this will depend on the business community support, obviously. So with that, I want to thank both of our panelists and thank all of you for your participation.